The market can stay irrational far longer than your firm can stay solvent. You can be perfectly right about the fundamentals, but if you're early, you're just dead money. Let's go.
Doc, tell me, why do half the pros on Wall Street treat currency forecasting like a game of Russian roulette?
It is not just roulette, James. Currency forecasting is notoriously difficult because currencies are the units of account for everything else. Imagine trying to measure the length of a room with a ruler that keeps changing its own size. That is exactly what happens when you compare assets denominated in different currencies. An exchange rate movement shifts the relative value of every single asset, liability, and service globally. Anything affecting expectations of prices or values within one currency triggers an immediate ripple-like reaction. Governments and financial systems add layers of complexity, as exchange rates often become targets of national policy. There is rarely any firm ground for an analyst, so we must assess the relative strength of various competing forces.
So like trying to weigh flour on a scale while the earth beneath it is doing the salsa?
Precisely, it is an analytical challenge of the highest order. We cannot find mutually exclusive approaches that stand alone here. Instead, we must view various perspectives as complementary tools in our kit. We start with trade in goods and services, which impacts exchange rates through three distinct channels. These are direct flows, quasi-arbitrage of prices, and the broader concepts of competitiveness and sustainability. While gross trade flows seem massive, net flows are usually small relative to the broader economy. If trade-related flows suddenly dwarf financing or investment flows, that is a classic warning sign of an emerging crisis.
Right, so if the trade tail starts wagging the financial dog, we're in trouble?
Exactly. Now, consider purchasing power parity, or PPP for short. This theory asserts that prices of goods and services should change at the same rate regardless of currency denomination. It relies on the mechanism of quasi-arbitrage to force price alignment after converting to a common currency. If PPP holds, the expected change in the exchange rate should equal the difference in expected inflation rates. However, PPP is fundamentally slow and often incomplete in its operation. While it provides a decent guide over multi-year horizons, it is notoriously poor at predicting movements over short or intermediate periods.
It's like a slow-moving glacier. Then it gets to the destination eventually, but you'll be waiting forever.
That is a perfect analogy. PPP ignores capital flows entirely, which often exert much more acute pressure on exchange rates. Furthermore, it assumes prices and exchange rates are already well aligned, which is rarely true. Not all goods are internationally traded, and trade barriers further complicate the picture. Economic developments can also force changes in a country's terms of trade, necessitating a change in the real exchange rate. PPP works best when inflation differentials are large, persistent, and driven by monetary conditions. This is the core assumption of the monetary approach. PPP holds, and inflation is strictly determined by the money supply.
Let's shift to the current account. Why does it act like a sustainability check for a country?
The current account balance is a critical indicator of structural health. Think of it as a country's long-term balance sheet, showing the gap between national saving and investment. A small deficit, perhaps under 2% of GDP, is often easily sustained for years. However, a deficit becomes problematic when it reflects low savings or weak fiscal discipline. Conversely, a deficit funding strong, profitable investment can be sustainable because it attracts foreign capital. We must distinguish between structural imbalances, like persistent fiscal deficits or demographic shifts, and temporary ones caused by business cycles. Ultimately, the adjustment process where the exchange rate changes to rebalance trade is incredibly gradual.
So if the trade balance is the slow-moving structural health, capital flows are like the caffeine-addicted day traders?
That is a sharp way to put it. When we speak of capital flows, we assume perfect capital mobility. This means capital moves instantly to wherever the risk-adjusted return is highest. This perspective gives us the building block approach for forecasting exchange rates. We calculate the expected return by combining the risk-free rate, the risk premium, and the expected change in the currency value. If the interest rate differential between two countries is positive, capital should flow to the higher rate currency. This pushes the higher rate currency up today, but also leads to a forecast of a lower future value. The market expects the exchange rate to depreciate to offset the interest rate advantage.
Wait, so if a currency offers me a higher return, the market is already betting it's going to crash later?
Precisely, and that is known as uncovered interest rate parity, or UIP. It states that high interest rates are perfectly offset by expected depreciation. However, in the real world, this is rarely true over shorter time horizons. Often, the higher interest rate currency tends to appreciate instead, a phenomenon known as the carry trade. Investors pile into the higher rate currency to capture the carry, which creates a self-reinforcing loop of appreciation. This contradicts the pure UIP framework and demonstrates how capital flows, often driven by hot money, can ignore fundamental parity conditions entirely. On the exam, you must distinguish between what parity conditions suggest and how actual speculative flows operate.
It sounds like the market is playing a game of musical chairs, and everyone is trying to sit in the high-yield chair.
It is exactly a game of musical chairs. The overshoot mechanism pioneered by Dornbusch explains this dynamic very well. Imagine a sudden, unexpected increase in the money supply. Prices are sticky in the short run, so they do not adjust immediately. Interest rates must fall to clear the money market, which makes the domestic currency less attractive to investors. Consequently, the currency depreciates sharply, often overshooting its long-term equilibrium level. Over time, as prices eventually rise, interest rates normalize, and the exchange rate gradually moves back to its long-term fundamental level. This illustrates why exchange rates are so volatile relative to slow-moving economic fundamentals.
So prices are like a stubborn mule that refuses to budge, forcing the currency to do all the jumping.
That is an excellent analogy. The stubbornness of goods prices compared to the fluidity of financial asset prices is the root cause. This discrepancy creates high volatility in exchange rates. When forecasting, you must analyze whether a currency move is driven by a genuine fundamental change or just a temporary liquidity-driven ripple. If you are asked to justify a currency forecast on the exam, you must link the interest rate environment to these capital mobility assumptions. Always remember that while UIP is a theoretical benchmark, the actual flow of capital is driven by relative interest rates and investor sentiment. Never ignore the hot money component when justifying short-term fluctuations.
Let's bridge this to portfolio balance. How does that change the view of the game?
The portfolio balance approach moves beyond just interest rates to focus on the composition of national wealth. It views the exchange rate as the price that equilibrates the supply and demand for assets denominated in different currencies. Investors have a home bias, meaning they prefer assets from their own country. If a country runs a massive current account deficit, it must issue debt to the rest of the world to fund it. Eventually, foreign investors reach their limit for holding that country's currency. To entice them to hold more, the currency must weaken or interest rates must rise, making the assets more attractive.
So it's like a party where the host keeps handing out drinks, but eventually, the guests stop wanting that specific brand.
Exactly. The portfolio balance framework is vital because it explains the medium to long-term equilibrium better than pure trade or monetary theories. It considers that foreign direct investment is a more stable form of capital inflow than short-term debt financing. If a country funds its deficit through long-term equity or ownership, the exchange rate is less vulnerable to sudden hot money flight. When you evaluate the sustainability of a currency, check the composition of the capital account. High reliance on short-term bank loans is a massive red flag for potential currency volatility.
So we have trade as the long-term anchor, capital flows as the short-term adrenaline, and portfolio balance as the structural weight. How do we put this all together for a country like, say, an imaginary Atlantia?
That is the exact right question for the exam. Suppose Atlantia has a large current account deficit, but high real interest rates. Analysts often struggle here because these factors pull the currency in opposite directions. First, you must determine if the deficit is financed by stable, long-term capital or volatile, short-term debt. If Atlantia relies on short-term hot money to bridge the gap, the currency is vulnerable to any shift in sentiment. If you are asked to determine the likely trend, you must analyze the consistency of these competing forces.
So if Atlantea's government is borrowing short-term to fund a long-term shopping spree, that's a bubble waiting to pop?
Precisely. And that is a key essay-style nuance. You would justify a bearish outlook by citing the fragility of the capital account composition. On the exam, never just state that a currency will rise or fall. You must explicitly justify your conclusion by weighing the trade balance against the capital account dynamics. Mention the building block logic, but temper it with the reality of portfolio constraints. Atlantea's high interest rates might attract inflows today, but if the current account remains persistently negative, the long-term outlook is fundamentally weakened.
That makes sense. It's like a person borrowing against a credit card to pay their mortgage. It works until the bank stops lending.
Exactly. Now let's pivot from forecasting the level of exchange rates to forecasting their volatility. This is a crucial distinction for risk management. Forecasting volatility is often more important for option pricing and hedging than knowing the exact direction. We often start with the simplest assumption that volatility is constant. However, empirical evidence shows that volatility is clearly not constant. It tends to cluster, meaning periods of high volatility are often followed by more high volatility. This is the volatility clustering phenomenon.
Volatility is like bad weather then. Once a storm hits, you know you're in for a rough week?
That is a perfect analogy for time series behavior. To model this, we move from simple constant variance to multi-factor models. We use these models to estimate the variance-covariance matrix, which is essential for portfolio optimization. The trade-off here is between bias and estimation error. A model that is too simple, like assuming constant correlation, introduces significant bias because it ignores reality. Conversely, a model that tries to account for every single factor introduces excessive estimation error. Your goal is to find the Goldilocks zone between these two extremes.
So if I'm too simple, I'm wrong. If I'm too complex, I'm guessing. How do we fix this?
We use a technique called shrinkage estimation. It is a sophisticated way of blending a simple model with a more complex data-driven one. Think of it as taking the sample data and shrinking it toward a more stable long-term average. This reduces the noise inherent in historical data without losing the underlying signal. On the exam, if you are asked to justify a model choice for volatility, emphasize the balance between consistency and precision. A good model must be stable enough to be useful while remaining sensitive enough to capture real market shifts.
So shrinkage is essentially the financial version of don't overthink it, but don't ignore the facts.
That is a brilliant summary, James. By shrinking the sample variance towards a more stable target, like an equal-weighted matrix, we filter out temporary noise. It prevents the model from reacting too violently to one-off shocks that are unlikely to repeat. This is critical because if our variance-covariance matrix is noisy, our portfolio optimization becomes a house of cards. We end up placing huge, unjustified bets on assets that just happen to have high historical variance. Precision must be tempered by stability to be useful in real-world portfolio management.
I get it. It's the difference between driving based on the last 5 seconds of traffic and knowing the general flow of the city?
Exactly. And you have hit on the core challenge of estimation error. If you rely strictly on the sample, you assume the future will look exactly like the past. That is rarely true. When you justify a specific model on the exam, you must mention that shrinking the estimation toward a target, like a constant correlation model, improves the out-of-sample performance. It is not just about fitting the past, it is about building a robust framework that can handle the uncertainty of the future. Never sacrifice long-term stability for short-term statistical perfection.
Doc, we've covered a lot. From PPP glaciers to hot money and shrinkage. Are we ready to summarize the GPS check?
Let's do it. We have established that exchange rates are driven by goods flows, capital flows, and portfolio composition, all operating at different speeds. Trade flows are slow anchors, while capital flows are high-frequency drivers that often overshoot long-term equilibria. Volatility, meanwhile, requires a careful balance between historical reality and model stability through shrinkage estimation. You cannot rely on a single approach. You must synthesize these perspectives to reach a defensible, analytical conclusion. Do you feel we have a firm grasp on the why behind these movements?
I do. It sounds like the secret to level 3 is realizing that these models are tools, not crystal balls.
You hit the nail on the head. These models provide the language to structure our thoughts, not the certainty of a guaranteed outcome. The exam will test your ability to apply these tools to different scenarios, like our Atlantia example. You must be able to determine the key driver in any given situation and justify your choice using these frameworks. Always look for the primary pressure point. Is it an interest rate differential, a structural trade deficit, or a shift in investor sentiment? If you can identify that, you can pass the exam.
I love it. So what's next on our deep dive into these capital market expectations?
We need to look at the practical limitations of these frameworks. For example, why do some countries maintain fixed exchange rate regimes, and how does that limit their monetary policy? This impossible trinity concept is crucial for understanding why certain currencies behave so predictably until they suddenly, violently don't. We must also explore the impact of central bank interventions on these currency expectations. Sometimes, the market is just a central bank fighting against reality, which creates fascinating and dangerous opportunities.
The impossible trinity sounds like a magic trick where the magician is secretly sweating bullets.
That is a perfect description of the policy trilemma. A country cannot simultaneously have a fixed exchange rate, free capital movement, and an independent monetary policy. It must choose only two. If a country chooses a fixed rate and free capital, it loses all control over its interest rates. This is why central banks eventually fail when they try to fight global market forces. On the exam, you must recognize when a country is pushing against this constraint. It is a fundamental limit that dictates the sustainability of any currency regime.
So the government is basically trying to balance 3 spinning plates, but they only have 2 hands?
Precisely. And when they try to use both hands to hold one plate, the third one inevitably falls. This tension is where intervention analysis becomes critical for our forecasts. When a central bank intervenes, they are either signaling their commitment or trying to manage volatility. However, intervention is often just a temporary barrier against the tide. If the fundamentals like that structural trade deficit we discussed point toward depreciation, no amount of intervention will stop the inevitable long-term adjustment. It merely delays the process, often making the final correction more painful.
It's like building a dam against a rising river. Eventually, the water finds a way around.
That is a brilliant analogy. When you assess a currency under a managed float, you must determine if the central bank is leaning against the wind or swimming against the current. Leaning against the wind, smoothing out short-term fluctuations, is manageable. Swimming against the current, trying to maintain a rate that is fundamentally misaligned, is a recipe for a crisis. If you are asked to determine the risk of a currency, always analyze whether the central bank's actions are consistent with the long-term economic fundamentals.
Got it. So we look for the misalignment, then look for the central bank's thumb on the scale?
Correct. We must differentiate between the official policy target and the market clearing rate. The discrepancy between these two is the potential profit or loss for a currency speculator. In our forecasting, we evaluate if the current account is sustainable at the official rate. If the answer is no, we expect a regime change, which often manifests as a sharp, discontinuous move in the exchange rate. These tail events are exactly what volatility models attempt to capture, though they are inherently difficult to predict with precision.
So if the dam is about to break, do we switch to a different volatility model?
We would certainly adjust our parameters. When a regime shift is imminent, historical volatility becomes a poor guide for the future. You need to incorporate scenario-based analysis rather than just relying on quantitative past-looking models. Think of it as switching from autopilot to manual control. A good analyst recognizes when the statistical model is no longer reflective of the political or economic reality. This ability to shift perspectives is exactly what distinguishes a master from a rote calculator.
Doc, let's talk about the global macro approach. Is it just educated guessing, or is there a system behind the madness?
It is absolutely a systematic process, James. Global macro analysts integrate these various models into a coherent investment thesis. They analyze the macro environment, inflation, output gaps, and fiscal policy to form a view on where the imbalances lie. They look for the divergence between market prices and their own internal estimates of fair value. If the market prices in a stable exchange rate, but their analysis shows a growing structural deficit, they take a position. They are essentially betting on the inevitable mean reversion of economic reality.
So they aren't guessing. They're just waiting for the market to wake up and smell the coffee?
Precisely. The market is often driven by momentum, which can keep a currency away from its fundamental value for a long time. However, gravity in the form of trade imbalances and interest rate differentials always wins eventually. Global macro managers look for the catalyst that will break the momentum and trigger the adjustment. On the exam, when you are asked to formulate a strategy, you must identify both the fundamental imbalance and the potential trigger. It is not enough to be right in the long term. You must have the stomach to survive the short-term volatility.
It sounds like being a professional contrarian. You need to be right, but you also need to be patient.
That is the most difficult aspect of the discipline. Patience is the ultimate competitive advantage in macro investing. Most traders get shaken out of their positions by short-term noise, even when their long-term thesis is correct. To mitigate this, we use the volatility models we discussed, like shrinkage estimation, to size our positions properly. We don't bet the house on a single idea because the timing of the adjustment is never certain. We size for the risk, not just for the conviction.
So position sizing is the seatbelt that keeps you in the car when the road gets bumpy.
That is an excellent metaphor. Without proper position sizing, even a correct thesis leads to ruin. If your volatility model signals that uncertainty is high, you reduce your exposure, regardless of how right you think you are. You must separate your intellectual conviction from your risk tolerance. An intellectual analysis says the currency will fall, but a risk analysis says don't put more than 2% of capital into this trade. Integrating these two is the mark of a sophisticated manager.
Doc, we've covered the philosophy, the models, and the risk management. Where does the final answer usually hide on the exam?
The final answer is rarely a single number. It is an argument. When you see justify or determine on the test, you must build your answer like a lawyer building a case. You state your conclusion, then you present your evidence, the fundamental drivers, and finally you address the risks. You must show the examiner that you understand the nuance of the debate, not just the mechanics of the formula. If you can clearly articulate the why and the what if, you are in a very strong position.
So don't just solve for X. Explain why X matters to the whole picture.
Exactly. For instance, if you determine that interest rates are the primary driver, explain how that interacts with the current account and capital flows. Don't look at any factor in isolation. The CFA exam is designed to punish narrow thinking. You must demonstrate that you understand how these gears fit together. Think in terms of relationships, directions, and second-order effects. If this factor shifts, how does it alter the impact of all other factors? That is the analytical depth the examiners are looking for.
Doc, what about the term structure of currency? Does it matter if I'm hedging for a month versus a decade?
It matters immensely, James. The term structure of currency expectations, the forward rate curve, is essentially a market-implied forecast. However, you must remember that forward rates are not unbiased predictors of future spot rates. They contain a risk premium. Over short horizons, interest rate differentials and liquidity dominate. Over long horizons, fundamentals like inflation and current account sustainability regain their predictive power. You are effectively navigating two different games depending on your time horizon.
So short term is about who's paying the most interest, and long term is about who's actually staying solvent.
Precisely. And on the exam, you must be able to switch gears accordingly. If they ask about a one-year hedging strategy, focus on interest rate parity and carry trade dynamics. If they ask about a 10-year strategic asset allocation, focus on purchasing power parity and structural economic shifts. Confusing these two time horizons is a classic trap that separates the candidates who pass from those who fail. Always ask yourself, Is this a cyclical fluctuation or a structural evolution?
That makes sense. It's like the difference between worrying about the daily weather and planning for the changing climate.
That is an insightful way to frame it. When you justify your position, explicitly define your time horizon. An analyst who says, based on the current interest rate differential, the currency will appreciate in the short term, but long-term fundamentals suggest a correction, demonstrates superior grasp. You are showing the examiner that you understand the multi-layered nature of currency markets. You are not trapped in a single model mindset. You are synthesizing the reality of different timeframes.
Is there a specific way we should present these dual viewpoint arguments to get the full points?
Yes, use a structured evidence-based format. Start with the short-term driver, explain the mechanics, then contrast it with the long-term fundamental anchor. Conclude by identifying which one is likely to be the dominant force given the current market environment. This shows you aren't just reciting theory, but actively applying it to a dynamic reality. It demonstrates that you can reconcile conflicting data, which is exactly what a senior analyst does in practice.
Doc, what if the data is just totally contradictory? The interest rates say one thing, but the trade data says another.
When data contradicts, you must identify the Mathieu primary constraint. Often, the central bank's willingness to defend a currency is the ultimate constraint. If they have massive reserves, they can ignore trade deficits for years. If they are broke, the market will force a correction instantly, regardless of what interest rates might suggest. You must identify the binding constraint in any scenario. The exam loves these what happens when everything goes wrong scenarios, so be prepared to identify the breakpoint.
So the central bank is the ultimate wild card in our model?
Exactly. And never underestimate the political dimension of that wild card. Central banks are not purely objective entities. They operate under government mandates that often prioritize short-term political stability over long-term economic logic. When analyzing a country, always look at the political cycle. If an election is approaching, the probability of intervention or policy shifts increases. The best forecasts incorporate these hidden variables into the risk analysis.
Doc, it feels like we're playing a giant game of chess where the board is constantly tilting. How do we keep our composure?
By focusing on the process, James, not the outcome. A disciplined analytical process prevents emotional decision-making when the board tilts. You must document your assumptions clearly. If you believe interest rate differentials are the primary driver, write it down. If that differential shifts, your process tells you when to exit. Never trade based on gut feeling without a supporting model. The exam assesses whether you can maintain that rigor even under pressure.
So the process is the guardrail that stops us from driving off the cliff.
Precisely. And remember, the CFA style answer is always objective and evidence-based. Even if you are personally skeptical of a model, you must show how to apply it correctly. You are evaluated on your mastery of the tools, not your ability to predict the future. When a question asks you to determine a result, show the logical steps, start with the theory, identify the parameters, and then state the implication. This structure is the key to demonstrating competence.
I love that. It's all about showing your work, like in algebra class, but the stakes are in billions.
Think of the exchange rate as an equation with three core variables: trade balance, interest rates, and risk premiums. When you shift one, the others move to maintain equilibrium. Your job is to describe the direction of that movement. If interest rates rise, does the currency appreciate or depreciate? Why? How does that impact the trade balance? If you can trace that entire chain of causality, you have mastered the material.
It sounds like the butterfly effect. A small flap of a central bank's wings, and we have a hurricane in the currency markets.
A small change in monetary policy in one country ripples through the global system. As analysts, we must be sensitive to these second-order effects. Don't just look at the immediate impact, look at how that impact ripples into other markets. That systemic awareness is what elevates an analyst from a technician to a strategist. It is a core of the Level 3 curriculum.
And there you have it. The core logic of forecasting exchange rates and volatility, simplified for the marathon that is the CFA Level 3 exam.
Remember, exchange rates aren't just prices. They're the intersection of trade, capital flows, and national policy. Whether you're navigating the Dornbusch overshooting model, or applying shrinkage to your volatility matrices, always look for the binding constraint. Stay disciplined, keep your analysis structured, and trust the process. You've got the tools. Now go apply them.